Hello and welcome to another edition of Deal Hunter. I'm your host, Mitch Flax, founder, CEO of Net Equity Capital. My man, my co-pilot, Tom Staub. How's it going?
How you doing, sir?
It's been a long time, too long. We've been negotiating your contract for the last 2 months. We finally met your demands, and investors want to know, is now a good time to invest? I'm hearing that question all over the place. What do you think?
Oh, man. It depends who you are, how old you are, what your plans are, and a variety of other questions, right? There's no doubt a more of a challenge nowadays than there was 12 months ago, right? So, and what do you think?
Look, it's a loaded question. One that we should probably break out a bottle of whiskey, although it's a Monday night and I've got a flight out to Chicago in the morning. But I will tell you, I think that's a very loaded question. There's so many other questions I'll then turn to the investor and pose to themselves. What is this money for? You know, is this short-term capital? Because if it is, I love cash. Although it's getting eaten away by inflation, what's the alternative? Do you want to try and actually time the liquid markets, right? I mean, look at where crypto is. You can't even get your money. There's an absolute liquidity crisis there. The stock market to a degree. So the short term to me, if you're trying to time the market, which very few people can do.
Yeah, here's the fun
I've
fact.
Tried it. I failed. Although I will say I've been net short since last November. And, you know, I got that right for now.
Yeah,
but
yeah, and here's the hard fact, right? 8% of money managers that do this full time beat the market, and that's, you know, netting out risk and return. And even fewer do that year over year. And these are people that have CFAs behind them. They have research teams. They work 60 hours a week. So yeah, great. You have some cash in the bank. Timing the market's not going to work unless you're just a seasoned pro and you're lucky. So
you're absolutely right. And my dogs were actually barking because they agree with
they were supporting my cause.
They support exactly what you're saying. Here's the thing. Look, long term, you're in great shape. Buy and hold. And if you don't need the money, set it and forget it. If you're in the stock market, what you said, 8% of money managers actively beat their respective benchmarks. The reality is just buy a low cost ETF. My friends in the active management world who are out there pushing their mutual funds to financial advisors who are selling on Monday morning returns. Yeah, go ahead. Sure, if it makes you feel good. But the reality is you want beta, go buy an ETF and forget about it long term. Nothing has changed there. You know, from a private equity venture space, if you want to be more hands-on and you're an active investor, here's the thing, or maybe a strategic investor, it's all about burn, right?
No.
What I'm hearing from my friends in the venture PE space, find the companies that can operate efficiently right now.
Yep.
Okay. Folks who can do more with less.
Well, let me take that, you know, a step further. If you look at our deals, right, we underwrite them in a way that when we do raise, we're overcapitalized for this exact reason. Most of our deals are coming to fruition in 2 to 3 years. So we're seeing this as a 12 to 15 month downturn and slight recovery. You know, and even on the equity side, we are seeing a slight pullback in some investors, more at the retail, you know, size. But the bigger institutions are still flowing out capital to the right deals. And even in that category, there's a handful that have pulled back, but money is still flowing into the right deals.
Blackstone just raised $24 billion for their next fund, right? So they're obviously going to get involved and they see some opportunities. But here's the deal. Whatever economic environment that we've been in, whatever global macro events that have happened, the show must go on, and the show does go on. We always invest, irregardless of what's going on in the marketplace. So really, short term, medium term, long term, yeah, short term, I'm sitting in cash. And thankfully, I just bought a real estate property a few months ago. The bank threw a covenant on me and they asked me to maintain a certain amount in liquidity, which I'm delighted for. I thank them all the time. I wasn't happy when they first asked me to do it because I wanted to deploy capital, right? And be a little bit more levered. But I think the idea on any investment is be less levered and tighten up those forecasted pro formas. If there's typical a 3 to 5 year hold, maybe, manage investor expectations a little bit better, because here's the reality. If we see rates continue to go up and you're developing a project or you've got a venture deal or anything like that, and just those multiples aren't there yet in that time horizon that you promised investors, and you got to hold the investment a little bit longer, because where else are you going to put it, right? If you're at a certain cost of debt right now and your cost of capital is 4 or 5%, and in 5 or 6 years that cost of capital goes up and supply is abundant, demand remains the same, where do you put that? Your free cash flow to take it.
About 6 months ago, Ivy Zelman came out, and I think we discussed this in one of the podcasts. Where's the risk in the market? It mostly, and Zuber and us talked about the same thing. The biggest risk that we saw was in the refis and the multifamily syndication space, right? Yep. They were banking on 5-6% debt fixed, and that's gone. That's not
5 to 6. They were getting 2 and 3.
Yeah.
So they're getting now.
Yeah. Well, it's going to be very hard for them to make sense of their pro formas. And I'm guessing they sold this idea at those rates. So they're going to be in a situation, especially if they're not overcapitalized. But again, you're right. You can expect in some ways longer hold periods, but at the same time, depending on what you're doing, if you're building a house, if you're doing land development deals that have materials, if you're building apartments ground up, you're starting to see commodity prices come down. Not all, but a lot of them, right?
They all mean revert. Look, most trades, they start to mean revert, and we are seeing that in the commodity space. There's no question. We certainly saw a supply side disruption. And, we listen to other podcasts, and some of the common themes are out there. They all make sense, right?